The financial golf swing is literally how we're using our money. But we have been trained to think that our financial success, our freedom, our independence is predicated on owning a product or paying off debt quicker. And if you follow that reasoning, basically every place we're putting our money, or more importantly, how we're using our money, is putting our money, our cash flow, and our dollars outside of our own reach. So then we need to access capital. And let's face it, that's the story of entrepreneurism. Access to capital. When we need to put our hands on money for an emergency, or worse yet, having an opportunity that we can't cash in on because we don't have access to capital, that's the most frustrating thing in my estimation for an entrepreneur. We want to go, and it's all predicated on access to capital. But all the ways that we've been using our money have been putting our money out of our reach.
This is the Entrepreneurs United podcast with your hosts, John St. Pierre and Rich Hoffman.
Welcome back, entrepreneurs and intrapreneurs. Today, we're sitting down with Tim Yurek from Tier 1 Capital, and Tim's been doing this for 40 years. This one major thing that you all need to listen up to. He helps entrepreneurs increase their cash flow. Does anybody need that? I think so. We all need help with cash flow. Tim, thanks for joining us here today.
It's my pleasure, and I'm glad to be here. Thank you.
So, Tim, in my experience, and I'm speaking my experience as an entrepreneur, I'm speaking as well as my experience in coaching entrepreneurs, we all love to look at our P&L. We all love to look at that profit and loss statement and go, am I making any revenue? How's my profits? How are my expenses? And then maybe sometimes we look at our balance sheet and go, okay, do we have too much debt? What's going on? But way too few entrepreneurs truly understand cash flow. Why is that such a big problem?
It's a great question. So we've done a lot of research on this, and here's what I can tell you. The Intuit company did a survey of business owners across the world, and they found that 61% of business owners, again, across the world, struggle with chronic or cyclical cash flow issues. Now, 69% of those people surveyed admitted to losing sleep or sleeping less due to cash flow concerns. Now, there's been a lot of studies on, how sleep deprivation increases. Here's the deal. Sleep deprivation increases our incidence of cancer by 200%. It increases our chances of premature death by 20%. And how about this? The average life expectancy of a small business owner is a full 5 years less than the average American.
Wow.
So now, let's layer on top of that my experience with business owners. They all have cash flow issues, either, again, chronically or cyclically. But here's the deal. My findings have found that every single case they've been self-inflicted cash flow issues. It's how they're using their money, or more importantly, how we've been trained to use our money by the banks, the credit companies, the investment firms, our major vendors, the large corporations we're dealing with. They're training us to use our money in a way that is detrimental to ourselves and our company. And what I found is if you just break that process, interrupt that process, so to speak, all of a sudden, you're going to be sitting on a boatload of cash.
Can you elaborate on what is the way that you believe business owners are trained? And then how does that get interrupted? What does that look like?
There's a lot of different ways. Again, we call this the financial golf swing. The financial golf swing is literally how we're using our money. But we have been trained to think that our financial success, our freedom, our independence is predicated on owning a product or paying off debt quicker or something like that. And if you follow that reasoning, basically every place we're putting our money, or more importantly, how we're using our money, is putting our money, our cash flow, and our dollars outside of our own reach. So then, when we need to access capital, and let's face it, that's the story of entrepreneurism, access to capital. When we need to put our hands on money for an emergency, or worse yet, having an opportunity that we can't cash in on because we don't have access to capital, that's the most frustrating thing in my estimation for an entrepreneur. We want to go, and it's all predicated on access to capital. But all the ways that we've been using our money have been putting our money out of our reach. And so consequently, when we need it, we can't get it. So, Rich, I don't know if I answered your question, but we've been trained by the financial institutions and the large corporations we're dealing with to use money, to put our money out of our reach when we need it most.
So let's say a small business owner, they would look at it and say, hey, it's very simple. I sell a thing or I provide a service. I'm going to have some upfront money that costs, either in the materials to create the thing or the machinery or whatever I need, the tools to provide the service. I'm going to put that upfront cost up. I'm going to provide the product or service. I'm going to collect money. Money turns into cash. I put that in my bank account. Sometimes I need to upgrade my tools. I need to spend money on marketing. Tim, what is it that's so confusing about this? What's the big trick you have that isn't that simple? That's just that. How am I supposed to keep my cash when I'm spending money on direct mail or SEO or SEM or previous customers, or I need to upgrade my equipment so I could turn out 10,000 widgets instead of 5,000? What's the trick?
So the trick is this, and that's a great, I'm glad you brought that point up, because what we found, it's not what you buy, it's not when you buy it, it's how you pay for it. That's the financial golf swing. And if you learn a new trick or a new process for utilizing your capital and your cash flow, all of a sudden you can control how much money you have access to. Let me share a quick story about a guy that I met, and he seemingly had everything put together. He was in his early 40s at the time. He owned a physical therapy business. He had 4 locations. He was making really good money. And when I met him, he said, hey, I don't know if I have a need for your services, because listen, everybody thinks they're using their money wisely. And I get it. I understand that. Nobody wakes up in the morning and says, hey, how could I screw myself up, or how could I set myself back financially today? Nobody does that. Everything we're doing, every move we're making, every strategy we're employing, we think is moving us forward. But here's the question. If what you thought to be true turned out not to be true, when would you want to know? And most people say, hey, right away. So here's the deal. This guy was, at the time, he had about $1 million in his retirement account. He owned 4 pieces of real estate where each one of his physical therapy offices was located. And he was making really good money. So here's the deal. He agrees to see me almost reluctantly because he didn't think I could add any value to him. And long story short, he had 2 business loans, which I thought he had created to purchase equipment for his physical therapy business. No, those loans were originally credit lines because he paid his quarterly taxes using draws on his credit line. And what happened was the line would max out, the bank would make it a term loan, like a 5-year loan or a 7-year loan, and then give him another credit line. Now that's really good for the bank, but here's the problem. Most of his cash flow was being allocated for that debt service, basically for paying back taxes. So my question to him was, how much income do you make? And he said 650,000. Then the next question was, how much income were you hoping to make when you were in college? And he chuckled a little bit and he said, about 150, 200,000. And I burst out laughing. He goes, what the hell's so funny? I said, isn't it ironic you're making 3 to 4 times what you ever dreamed you could make, and you can't pay your friggin' quarterly taxes without taking a draw on your credit line? And he leaned back and he goes, well, that's just the way I do it. So that doesn't make it right, does it? And he said, see, listen, when you know people are screwing up, you can't be afraid to point it out to them. Because as a business owner, as an entrepreneur, we're all big boys or girls, right? And we need somebody to tell us when we're going off the rails. So I said, hey, here's the deal. If I could show you a way you would never, ever have to pay for your quarterly taxes using a draw on your credit line, would that conversation be worth 45 minutes of your time? He said, yeah. So this was the summer of 2019. We put a plan together. We pointed out there's a lot of education to what we do, because think about it. These are things you've been doing all your life. So there's a bit of a paradigm shift. We have to educate you on the proper way of doing or utilizing your cash flow. And so after a couple months, we put a plan together. It was July 8th of 2020. He texted me and he said, hey, I just left my CPA's office. We filed our 2019 taxes on extension. And he said, I had enough money set aside to pay our tax obligation for 2019, but better yet, I have enough money set aside for our September quarterly, our January quarterly, and what we've estimated we're going to owe in April for 2020. Thanks for all you do for me and my family. Now, if that was the end of the story, is that a good story?
Sure.
Fast forward to December of 2022. We're meeting in my conference room, 7 o'clock on a Friday morning, me, him, and his CPA. And between what he had set up with me, and now he had grown his business to 7 locations, which we all know requires capital, true?
Yep.
7 locations. He owns the real estate on all 7 locations. He also bought a beach house during that time period. And each company had its own separate checking account. The amount of cash he had on hand at the time was $1.8 million. Now listen, I'm not a friggin' genius, but here's the deal. That individual always had the potential to have that amount of cash on hand. He was just pissing the money away, doing things the way he thought was the right way.
All right. So hold on. I don't mean to interrupt the story. It's a great story, but I'm sitting here as an entrepreneur going, okay, I get it. What did he do? What did he change that was so fundamental of a change that created this? Now, I don't want to give away your secret sauce necessarily, but if I'm listening to this and it's only going to be a story, tell me, how did this happen? I need to know some of the things that happened here to break out of that cycle.
It's real simple. We view things through the lens of being in control of your cash.
Okay.
Being in control of your cash flow.
Okay.
Every other professional out there is viewing things through the lens of rates of return. How little can I pay in taxes today? They're not playing the long game. And the irony is, when you play the long game, you win the short game.
Okay. How do you do that though? What is the actual tactic that, like an example of a tactic that would not play the game they want to play the way that you should be playing as an entrepreneur?
Okay. So here's one that we did with another guy. He owned a fuel distribution company. He would buy his trucks, and those pumper trucks cost about $350,000 each. He would buy those trucks and he would finance it over 18 months on it with a draw on his credit line.
Yep.
And so they also needed cash to fund a succession plan. He had a partner. And it was going to require about $60,000, $5,000 a month. And I said, this is what it's going to cost to solve the problem. And he said, we don't have that money. I said, again, I had access to his financials. He had provided that when we did the business valuation for him. And I said, what would you say if I told you you already have the money? You're just using your cash flow inefficiently. And again, nobody wants to be told that. He took exception to that. But then I pointed it out to him. And I said, here's what I would recommend. Instead of paying that loan off in 18 months, would it kill you if you paid it off over 24 months? He said, no. But again, the focus is on the interest rate. I'm going to get killed with paying interest. Do you know what the amount of interest he was going to pay extra over that time period? It was $7,800. And I said, would it warrant you paying an extra $7,800 to have $2 million of cash value life insurance available for you and your partner in case either one of you died? He goes, yeah, that'd be awesome. How do we do it? And I just said, just pay it over 24 months instead of 18 months. Free up some cash flow and use that cash flow to fund your succession plan. And ultimately, it's funding a succession and an exit strategy. So how they were using their money, they were paying off their debt too quickly.
Okay.
And why would you want to pay off debt at the time? The credit line was charging 2.75% interest. Why are you in a hurry to do that?
I just want to jump in for a second. So the tactic that I understand in this particular example is way too often, and you said this to begin the call, you said that we're way too often we try and pay down our debt too early. It was an example, right? And I think that one of the lessons that you're talking about regarding cash flow is $1 today in your bank account, or access to that dollar today in your bank account, is more important than $1 paying off a debt or buying another thing that you may need or whatever it may be. So if I had to ask, what are 5 ways, if you had the bullet point, don't even give me the explanation, just like bang, 5 things that entrepreneurs could do to increase the cash flow they have in their business. I'll even start with number 1. Don't pay down your debt too early. Renegotiate for longer terms, right? What would be 2, 3, 4, 5 in bullet point format?
Yeah, how they're funding their retirement is putting their cash out of reach. The amount of taxes they're paying, again, we did some research. 71% of all business owners overpay on their taxes.
Yep.
And they're overpaying, get this, by somewhere between 35 and 75%.
Wow.
So it's taxes,
Yep.
how you're paying your debt, how you're funding your retirement, how you're paying for your children's college education. And the big one is how you're making major capital purchases.
Okay.
Now, ultimately, where we get our clients is to put them in control of the financing function. So they never have to depend on a bank or a credit company for access to capital.
Mm.
They're borrowing against their own money and paying back to an entity that they own and control.
Okay.
And if you step back from that concept or from what I just said, ultimately what happens is you're now in control of the financing function as it relates to your business.
Okay.
That's freedom, that's independence, and that's what business owners want.
Love it. So can I do a little personal case study with you and get your opinions on something that I'm doing that love to get your thoughts on? So fairly sizable construction company, lots of liability in construction companies. We have set up a captive insurance company to provide additional extraordinary risk liability coverages for above and beyond our commercial liability policy. We own the captive company. So we pay premiums from our company to our captive company to get all that risk coverage. That money then goes into investment accounts, whatever's not used for coverages in the pool. And if ever we need access to capital, we have it there. But then also that insurance is a tax deduction to the income of the business. So our company has a tax benefit. The money in the captive is, when taken out, is going to be capital gains as opposed to ordinary income in this business. Is that a particular strategy as an example that you would recommend and or would work to minimize the taxes, provide your own financing if you need it, things like that?
Oh, yeah, absolutely. That definitely puts you in control. We always say you're either going to be controlled by the process or you're going to be in control of the process. When you give your client, again, entrepreneurs, when you give them that option, it's not a question. They became entrepreneurs. Why? Because they want to control their own destiny. And then what do? They sign their lives away to the banks. Whoever controls your cash flow controls your life.
No doubt.
Tim, one strategy I'm aware of where you can borrow money from yourself and then pay that back would be cash value life insurance. What
Yep,
are other vehicles that you would recommend people use in addition to cash value life insurance?
that's a good question. So you don't need cash value life insurance to employ this process. It just so happens that because you could do it with a credit line, you can do it with a savings account, an investment account. You can do it with real estate equity. It just so happens that cash value life insurance is the easiest, safest, and most economical way of doing it. Because ultimately, not only do you build a pool of capital, but you also take care of other things like if you have business partners, so you have a succession plan already built into it. So you got $1 that is funding your succession plan. That's what we did with the fuel oil company. And then we showed them how to leverage that money. Oh, let me add a quick thing there. So when we set the plan up with the fuel company, two partners, I said, hey, by the way, you'll be able to access this capital. They said, oh, we would never do that. And I said, why not? Interest rates are 2.75%. How much is it to borrow against the insurance? At the time, it was 4. Again, we're trained 4 is better than 2, or 2.75 is better than 4, right? So fast forward to this past August of 2023. I get a call from the principal and he goes, hey, do you remember you said I could borrow against those policies? I said, yeah. He goes, what does it cost for a loan? I said, what's changed? He goes, what do you mean? I said, what's changed? You told me you would never do this. And he said, I took a draw on the credit line. This was in August. He said, in July, I took a draw on the credit line. We bought another pumper truck. I said, okay. And he said, I just got my credit line statement. Those SOBs want 9.75% to finance, to take for my credit line. And he said, so what's it going to cost on the insurance policy? And I said, at the time, it was 5.25%. It's now 5.5%. And he said, I want one of those loans.
Yeah.
He said, how difficult will it be? I said, Chris, when you get a loan at the bank, you have to apply and you're seeking approval, correct? He goes, yeah. I said, when you're borrowing against a life insurance policy, you're giving an order. That is not a small distinction. That puts you in control. So he said, how hard will it be? I said, I could get the loan for you, but here's what I'm going to do. I'm giving you the 800 number. You call customer service. They don't know you from a bottle of Vicks. Let's see how easy this is. So he called back and he said, wow, that was simple. He said, they didn't even ask me what I was going to use the money for. That's the way it works. He said, they said I should have a check in my account. They ACH the money. Actually, it was $425,000 because those trucks got, with inflation, the cost went up. So he said, they said I'll have it in a week. I said, do me a favor, call me when you get there. So called me one day and he said, hey, I just got a check for $425,000 put in my account. I said, I told you that would happen. He goes, I didn't believe you. But it's that simple. So now he's in control. Now he could pay back at any rate he wants. And if cash flow is good, he could double down. And if cash flow is not so good, he's not obligated to make the payment. It's unstructured payments. So that's why we think cash value insurance is probably the easiest way to do this, or the most effective way.
And what type of cash value insurance do you typically recommend? Do you typically recommend variable universal life, indexing? Like, what do you recommend?
Rich, this is a great question. I'm glad you brought it up. This is all a preference. There's a lot of guys out there pushing these universal lives, index universal life, variable universal life. I've been in the insurance and financial services industry since 1985. I've never seen one of those products that worked. Now, that doesn't mean that they aren't out there, but I know this. Universal life, when it first came out, was the golden child of the insurance industry. That fizzled out, and it took a lot of companies down with it. But the insurance industry was dead set on trying to compare life insurance to other investments. It's not. All you're going to get in an insurance policy is 4 to 5%. Be happy with that. Because it's a collateralized loan, you could access that money and you're still earning interest even though you're using that equity. So, what's wrong with that? But no, the insurance industry wants to, oh, we can get you equity based investments. No, you can't. Variable universal life doesn't work. Equity index universal life doesn't work. And there's people out there that are going to tell me that I'm full of crap. Well, okay, fine. If that's what you want to do it, here's what I know. I could sell those policies. I could make a hell of a lot more money, and I don't own them, and I definitely will not stake my reputation by recommending them. That's my story, and I'm sticking to it.
Yeah, tell me more. Why would a indexed universal or variable universal, why would those fail more likely than something that's more fixed or of a modest percentage on a schedule?
Because it's not about rate of return. It's all about how the plans are designed. The way a whole life insurance policy is designed, the cash value has to be greater tomorrow than it was today. It has to, and it's actuarially designed to be better tomorrow than it is today. Universal life, variable universal life, equity index universal life, anything they come up with in the future, there's no guarantee that the cash value will be greater tomorrow than it is today. So that's number one. If you understand the way insurance is designed, you have to realize that it's all based on having a smaller net amount at risk. What's net amount at risk? Net amount at risk is I have a $100,000 death benefit and I have $30,000 of cash. My net amount at risk is $70,000. Next year, my cash value is going to be, let's say, $32,000. Now my net amount at risk is $68,000. So that net amount at risk is going down when the mortality cost is going up. So the net amount at risk is the insurance company, they only have $30,000 in your policy. They need $70,000 of insurance on the side because if you die that year, they got to come up with $100,000. With universal life or equity index universal life or variable, you could have $30,000 of cash, you could have $100,000 death benefit, but with variable, your cash value could go down. So now let's say the next year, instead of 30 or 32, you have 28. Now the insurance company has to buy 72,000 of death benefit if you die. And oh, by the way, you're a year older. Now, when you're in your 40s, it doesn't matter. But when you're in your 50s, 60s, and 70s or beyond, those mortality costs really start to eat away at the cash value. And listen, you could test this. Look at the illustrations in your policies. And when you see the point where the cash value starts going down, the genie's out of the bottle. You ain't ever going to get it back in. And now it's just a matter of hoping that you die before the policy does. That's no way to live. That's not planning. And again, that's why I don't recommend that. Does that answer your question?
Yeah, I think so. Let me just validate, because I
Yep.
learned a piece about life insurance that I was not aware of prior to the education you just gave. Thank you. The cost of the policy is the net amount at risk times the mortality costs. And one of the reasons why you prefer whole life is that net amount at risk is guaranteed to go down as the mortality costs go up. And eventually that net amount at risk may ultimately potentially be zero, because the net amount at risk is a face value minus a cash value. That net amount at risk is what the insurance company has at risk, which is why they charge you the mortality costs on that. So what
Correct.
happens to the cost if you have more cash value than face value?
Then your death benefit grows.
And is there no cost? Is there, because if your net amount at risk is zero times the mortality cost is zero. So what happens to the cost basis as you have more cash value than you have face value?
So there's a couple components there, Rich. And first is you have the base policy. Let's say it's a $100,000 base policy.
Yeah.
But then you're putting extra money in the policy through paid up additions.
Yeah.
A
You're
paid up
overfunding
addition.
it, not to the modified endowment contract, but you're maxing it out.
Yeah, exactly.
Okay.
But that extra money, the overfunding, is buying paid up life insurance. And then that paid up life insurance, so let's say you put in an extra $10,000. That might buy you $25,000 of paid up life insurance. Now next year, you're going to put in another $10,000 extra. That paid up policy from the first year is going to kick off a dividend, and that extra $10,000 is going to buy another, let's say, maybe not quite 25,000. Let's say it's 24,500 of paid up. But then in the third year, those two paid up pieces are going to kick off dividends. And the one from last year is going to have a smaller dividend than the one from 2 years ago. And it's just going to go on ad infinitum. So as your death benefit grows, the insurance company is literally taking it apart and saying, okay, this is the cash value or the reserve, the net amount at risk on the base policy. But then we have these two paid up pieces. And then that'll just keep going on forever. So at some point, to your point, you might have more death benefit than the original face amount.
Yeah.
But if you started off at 100, when you die, you might have 400,000 of death benefit.
Yeah.
So I don't know if that answers your question, but
so if you're at the point where you have 400,000 in death benefit, there's zero net amount at risk. So what happens to what you're being charged?
No, you're still being charged.
Okay.
Because what's happening is that 400,000 of death benefit might literally be 360 of paid up life insurance and 100 of the original face amount, of which 25,000 or 50,000 is of cash value. There still might be a net amount at risk on the base policy. That's the chassis on which we're building.
Okay. Got it. And can absolutely see, as your cash value grows, the ability to just put in a call, get your money. You don't have to apply, and be able to pay that back. And that's a good thing. That puts you in control of your cash flow.
You could pay it back on your timetable or within your cash flow, right? So when you work with a bank, what you get a coupon booklet or a payment schedule, right? With a life insurance company, it's an unstructured loan. Nobody's putting a gun to your head to make the payment. Nobody's putting a gun to your head to get it paid back sooner or later. So that allows our entrepreneur clients the flexibility of doing things on their schedule and within their cash flow.
Good.
And that's the control that we offer our clients.
Yeah, thank you for being on today. If people want to get more of you and understand how this can work for them, how would you like them to get in touch with you?
They could go to our website, www.tier1capital.com. And we also have a free gift. So if they do tier1capital.com/free gift, we'll give your audience, we call it our 6 considerations when looking for advice on business succession and executive retirement planning. And there's 6 questions that you should be asking anybody who's going to help you with those issues. And again, that's where we think we provide tremendous value, because not only are we solving the succession and the executive retirement issue, but we're actually finding the money to pay for those initiatives. And the money's there.
Great. Thank you so much, Tim.
All right. Thank you.
Thanks,
Appreciate
Tim.
your time.
Stay tuned as John and Rich unpack today's conversation.
Rich, we were taught from our parents that you should go work somewhere for 40 years, get the gold watch, the pension plan, all those kinds of things. And slowly but surely, things just keep changing. And the one thing that's changed in my paradigm over the last few years, and Tim just hits it right on again, is this old traditional system of debt and banking and interest rates. And we had one of the Kwok brothers on talking to us recently about mortgage interest rates and how to get rid of your mortgage in a lot less time, and kind of where people are so trained in one way how to view things, when really, quite frankly, to create wealth, you got to do it the other way around. And the part that I've changed my mind is I want to be my own bank. I want to pay interest to myself, to my companies. And if you can build nest eggs, whether it be through your own investment accounts or life insurance or either the captive insurance program or other programs, where you can actually build your own nest eggs, where you can borrow money from yourself for these capital purchases, for paying for your kids' college, for tax savings, whatever it may be, you actually start creating the wealth that these banks have been creating for many years. So I find that concept, that paradigm shift of try and create your own bank for yourself, to be absolutely genius, and more entrepreneurs need to hear it.
Absolutely. Who do you remember? It was, what is it, Robert Kiyosaki that wrote Cash Flow Quadrant, and
Yeah.
we read that way back in the day.
100%.
And I saw a video of his in the last, I think, week or two, where he was talking about what he does that's different. I think he was selling one of his seminars, and he said, I use debt as a tool, and then I pay less taxes.
Yeah.
That's how you get wealthy.
Yeah.
And there are things that are just counterintuitive, absolutely, for the average person. If you haven't heard of things like debt is a good thing, depending on what you have the money going to, of course you would think that is a bad thing. And to be able to self-fund things is so important. I know, just as we were going and chatting with Tim, I had brought up the book, Becoming Your Own Banker. And that's by Nelson Nash. And that book has a lot of information about this strategy of using cash value life insurance and how you can become your own banker in it. And in the conversation with Tim that was not recorded, he had even mentioned, yeah, Nelson was a mentor of his.
Yeah.
And Nelson, as a matter of fact, came and did 10-hour seminars for people who would ultimately become clients of Tim. So this concept of becoming your own banker really can revolutionize how people look at cash and getting access to it and being able to pay things back on your own terms rather than the terms of a bank or a lender.
Yeah, it's the wealth building mechanisms that when you're running your business 100 hours a week, running 100 miles an hour, trying to get everything figured out, shoveling crap in the corner, rolling your sleeves up, trying to get products and services done, you don't really see how your business could be actually using its cash flow in a lot of different ways. And one of the reasons, Rich, I have found is if you do have a loan, let's just say you do have to get a loan for your business. The first thing a small business entrepreneur is going to be forced to do is sign on the line which is dotted, which says personal guarantee. I've been there. I have some loans with personal guarantees with the bank. And I can tell you what, Rich, I want to pay them off as soon as possible. I do not want anybody to feel like they have me, right, in a situation where everything else I'm building could be at risk. But the banks know that. And so the ability to actually learn early to put cash reserves in other areas that can build up your accounts. As an example, I think you know this, I'm not 100% sure, just for conversation. If you build an investment account with the proper investment bank or wealth advisors or family office or whatever it may be, and you build $1 million investment account, example, with equities, with Apple stock and Microsoft or whatever, you can loan up to 65% of that back to yourself at lower interest rates than you could go get a bank loan for without any personal guarantee. So why do you go to a bank to get a car loan? To pay them the car loan? Just loan it against yourself. Pay yourself the interest. In that case, I guess the bank would be making a little bit, but they're collateralized off your assets. There's no personal guarantees involved, things like that. So there's a lot of ways to do this. And you dove a little bit deeper into this insurance part. I think back to our post-college days, we were involved in a company that sold some variable universal life and multi-marketing type of venture. You knew a little bit more about that than I could remember from that space. But I think what he said to us resonated true from my experience anyway with some of those products back in the day. Did that resonate true with you? Or did you, when you think about those products, did they give you a new sense of understanding of those products from what he was talking about?
I definitely learned a couple of things. I'd actually never even heard of that term on the net amount at risk.
Yeah.
And that's interesting to know. To answer your question, I'll tell you, I have whole life. I do not have universal life.
Same here.
Even though back in the day, we sold universal life. So that would probably be the easiest way to describe my opinion or position on the topic, is what I personally own. How about those stats that he gave? 69% of entrepreneurs have lost sleep over cash flow. And I know,
Me.
I know cash flow and access to liquidity is one of the chapters in your book, as a matter of fact.
Yeah.
Yeah. So, and then some of the consequences of it. I didn't know these. 200% increase of cancer, 20% increase of premature death. Did you know, prior to this conversation, the life expectancy of a business owner is 5 years less? I had no idea.
No, I don't want that to be me either. Rich, I don't know. I really do not know. I can't believe it's 69% had sleep issues because of cash flow. I would say it was 100%.
I can't believe it's not higher.
I don't know an entrepreneur that has not had stress or sleep deprivation or whatever it may be from cash flow. I can tell you recently in some of the businesses that I'm involved with, there's been that issue because it goes up and down. And even when you do have, as an entrepreneur, even when you do have some of these reserves, let's say you had this life insurance policy you could loan against, you also are trained not to do it if you don't have to. So you try and muscle your way through it, and it can get stressful. But if you can build up these reserves in these areas around you where you don't have as much stress, yeah, it's stress maybe, but you also know you have an escape valve. You can protect yourself. You can fund that rainy day. You can buy that piece of equipment you need or fund this new contract that you need to get. All that's really important. You know, the secrets, if you will, a little bit of how some entrepreneurs really grow their businesses from small business to medium business to high performance business is they really learn all these cash strategies we talked about as an example with Tim. And there are a lot of the ones we cover at our Entrepreneurs United Empowerment Experience. Again, not to self-publish what we do, but with Entrepreneurs United, our Empowerment Experience, we bring a lot of people in to talk about these exact type of concepts of how to create wealth for you and your family through your business. Entrepreneurs should join us there in Charleston, September 23rd to 26th, if interested in that, because these are the types of things we love